Ever wondered why Chinese stocks have lost $6 trillion in 3 years? Imagine a colossal economic powerhouse facing a financial meltdown. In this video, we're going to dissect the Chinese stock market crash, a crucial event that has left a profound impact on the global economic landscape. We'll explore the causes of the crash, from a record downturn in real estate and deflation to ideology-driven policies that have scared away foreign firms. We'll delve into the impact on the Chinese economy, a country now facing a crisis of confidence among investors and a potential stagnation that could last for decades. And we won't stop there. We'll also examine the global implications of this economic turmoil. It's a complex web of events and consequences, and we're here to untangle it for you. So, are you ready to dive into this financial maelstrom? Let's delve deeper into each of these aspects to understand what has been happening. So, what caused the Chinese stock market to lose such a massive amount of value? Well, it's a confluence of factors that have contributed to this crash, striking at the core of the Chinese economy. Let's start with the downturn in real estate. You see, real estate has long been a driving force of China's economy. But recently, it has been experiencing a record downturn. This has not only impacted the wealth of property owners and developers, but has also caused significant damage to the broader economy. This is because real estate is intertwined with many other sectors, so when it goes down, it drags a lot of other areas with it. Next up is deflation, a general decrease in the price level of goods and services. Deflation discourages spending and investment as people expect prices to fall even further. This creates a vicious cycle that slows economic growth, leading to a decrease in corporate earnings, which then reduces the value of stocks. Then there's the issue of debt. China's debt pile has been growing for years, fueled by a credit boom. High levels of debt can lead to financial instability, making it harder for businesses to obtain credit and invest, which in turn can lead to a decline in share prices. Demographics also play a crucial role. China is dealing with a falling birth rate and a shrinking workforce. A smaller workforce means less production and consumption, which can slow economic growth. This can negatively impact the profitability of companies, leading to a decline in their stock prices. Lastly, the country's ideology-driven policies have scared away foreign firms. These policies, which prioritize state control over market forces, have raised doubts about the business environment in China. This has led to a withdrawal of foreign investment, further contributing to the stock market's decline. All these factors combined have led to a crisis of confidence among investors. They're worried about the lack of effective policies from Beijing to spark a sustainable economic recovery. This crisis of confidence has caused investors to sell their holdings, further driving down share prices. As you can see, the causes of the stock market crash in China are complex and multifaceted. It's not just one thing, but a combination of internal and external challenges that have led to this situation. It's a stark reminder of how interconnected the different sectors of an economy can be, and how a problem in one area can quickly ripple out to affect the whole. In the end, it's the investors who bear the brunt of these issues as they watch the value of their investments plummet. So, how has this crash affected China's economy? Well, the stock market crash has created a ripple effect that's been felt far and wide across China's economic landscape. We're witnessing a slowdown in growth that's been unprecedented since 1990. In 2023, China's economy grew by a mere 5.2%, and predictions for this year are even more dismal, with expectations hovering around 4.5%. This slowdown isn't a temporary blip on the radar. It's seen as a structural change, an indicator of a long-term issue that could potentially lead to decades of economic stagnation. The stock market crash didn't just hit the investors' pockets. It's caused a nationwide crisis of confidence, raising questions about China's future and its ability to sustain economic growth. Faced with such a daunting situation, the Chinese government has been scrambling to respond. Measures to support the yuan have been implemented, with banks being asked to sell dollars. there's also talk of direct intervention to prop up the stock market. But here's the thing, while these measures might seem aggressive, they've yet to restore investor confidence. The stock market remains volatile, with investors concerned about Beijing's policy stance on the economy, the dominance of the state sector in key industries, and the ongoing tensions between China and the United States. Premier Li has made vows to take action and boost the stock market, but the specifics of these measures remain unclear. In the face of such uncertainty, public anger has been triggered, with calls for regulators to take effective measures to stem the decline. So, in essence, the impact of the stock market crash goes far beyond the trillions of dollars lost. It's led to a slowdown in economic growth, potential long-term stagnation, and a crisis of confidence that's shaking the very foundations of China's economy. These measures have yet to restore investor confidence and stabilize the stock market. And what does this mean for the rest of the world? Well, let's start with the impact on global investment. With $6 trillion wiped off the value of Chinese and Hong Kong stocks over the past 3 years, the world's investors are feeling the pinch. This massive loss has led to a crisis of confidence among investors who are growing increasingly wary of the lack of effective policies from Beijing to spark a sustainable economic recovery. And this isn't just about the money. It's also about the potential ripple effects on global economies. It's important to remember that China's economy is deeply intertwined with the rest of the world. When it sneezes, the global economy could catch a cold. China's slowdown could mean less demand for commodities, which could hurt countries that heavily rely on exporting these goods. Now, let's talk about trade. China is a significant player in global trade, and a slowdown in its economy could have far-reaching implications. Reduced economic activity in China could lead to lower demand for imports, impacting economies around the globe. On top of all this, the situation is further complicated by the ongoing US-China tensions. The tug-of-war between the world's two largest economies could exacerbate the situation, leading to greater instability in global markets. And let's not forget the role of the state sector in key industries. The dominance of state-owned enterprises in China's economy has often been a point of contention. The current economic situation could intensify these concerns, potentially leading to further tension and uncertainty. So, in a nutshell, the Chinese stock market crash is more than just a local problem. It's a global concern that could affect everything from your investment portfolio to the price of goods in your local supermarket. The Chinese stock market crash is not just a domestic issue, but a global concern. So, to summarize, we've delved into the labyrinth of the Chinese stock market crash, a financial calamity that saw $6 trillion evaporate from Chinese and Hong Kong stocks over a span of 3 years, a crash that was not a sudden event, but the result of a series of interconnected issues that have been brewing for some time. We've explored the causes that led to this significant downturn, with the Hang Seng, Shanghai Composite, and Shenzhen Component indices all experiencing significant losses. The root causes of this crash are manifold, from a record downturn in real estate and deflation, to debt, a falling birth rate, shrinking workforce, and ideology-driven policies that have spooked foreign firms. Moving onwards, we've discussed the impact of this crash on China itself. The Chinese government, in its bid to control the situation, has been pulling strings on various fronts, from asking banks to sell dollars to support the yuan, to considering direct intervention in the stock market. Yet, despite these measures, the confidence of investors remains shaky, fueled by concerns about Beijing's policy stance on the economy and the dominance of the state sector in key industries. We've also delved into the ripple effects that this crash has had on the global stage. With China's economy growing at its slowest pace since 1990 and a further slowdown expected, the repercussions are far-reaching. The situation is seen as structural and could lead to decades of stagnation, raising concerns not just among investors, but policymakers worldwide. However, it's important to remember that this situation is complex and continues to evolve. The interplay of factors that led to the crash and its subsequent impact are still unfolding. As we navigate this financial maze, it's important to keep an eye on the bigger picture, as the policies and decisions made in response to this crisis will shape the future of the Chinese and global economies. Understanding the factors behind the Chinese stock market crash is crucial for investors and policymakers alike. As the situation continues to unfold, we will keep you updated with the latest developments.